Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number here. Now, I know it's strange that you're all thinking, yes, you are giving us the phone number, we call it, and there's a voicemail. Well, the reason for that is because I need to think about what you're asking me. What you're asking me are probably technical questions or questions very specific to your needs. I have answers. I have people that have answers. The best thing for me to do is to call you back after the show. So I'll mention the phone number. I'll ask you to call it. You can certainly email me, info@malibufunding.net. We're on YouTube. If you go to YouTube, we're on a YouTube channel called Jeff Barton, the real estate voice, and there's a lot of information out there about what's going on in the market today, about what's happening in order to make your decisions easier. What is happening to make your decisions easier? Well, most of the information that we talk about on the show is online. I've been at this business for 25 plus years. And so my knowledge is based on my experience of working with people and of trying to get you into the mortgage that you need to get into, or find you the house, or all the things critical to housing needs here in, it's coming into fall 2019. But for you, if you want a quick education, there are certainly places to go. My particular YouTube channel is one of them. We talk a lot on the show about problems, solutions, people you can see. The interviews are there, people you can see for yourself and call directly if you want. There's also some great sources and also on YouTube for how to do certain processes, how to fill out a loan application, how to improve your credit score, how to a myriad of things that you're going to need in order to get the best rate possible on the best terms. Now, speaking of the best rate and the best terms, the rates today are about what they were last week. If we're talking a national average, which is like what we do here on the show each and every week, is give you an idea what's out there in the product land. Every case is different. Every situation is different. But if you're a 750 plus FICO score person, 20% down on a purchase, and you have income that can afford your particular area that you want to live in, and I want to talk to you about that. There was an interesting article today I noticed about certain cities around the country and how much you had to make in order to afford the median price in that market. Sounds like a lot of gibberish, but what it really means is in California, where the show is aired, Riverside, San Bernardino counties, hello, and up there in Tahoe, hello again. We bring you the show, and we're happy that you're each and every week listening. I know you're listening because I do get the calls, I do get the emails. But in cities in Southern California and in Tahoe, certainly San Jose area, you've got some unbelievable figures. And again, I'm going to share that with you of how much you got to make to buy the median priced home. What does that mean? Add up every home that's sold this year and divide it by 2, and that's basically your median home price. Anything above that is, of course, above the median. Anything below is below the median. But that is what's important when you're out there looking for houses, because there are things called the debt-to-income ratios. We don't talk a lot specifically about the process or what you need, but if you look at your income, how much of that income are you allowed to spend on your mortgage according to what the guidelines are with Fannie Mae, Freddie Mac, FHA, HUD, or a non-QM lender? I would say an FHA loan, you could probably get away with 50 to 55% of your income being spent on your mortgage. Sounds like a lot. It is a lot, especially let's say you're making $100,000 a year, right? Make the math simple. That means up to $55,000 of that $100,000, and that's pre-tax dollars, you have to spend on your mortgage. That's really pushing it. But in this market in Southern California, that's what you have to do in order to get an FHA loan for 3.5% down. On other typical types of loans, the ratios are different. But that's what debt-to-income ratio is, and that's why it's important to understand the different choices in the marketplace when it comes to things like, okay, I could live in this house in Los Angeles, downtown, let's say, or I could move to the outskirts of Riverside County, San Bernardino County, up in Hemet or Hesperia, or maybe out in Paradise or some of these other places. You could probably get a lot more for your money. And the reason is simple, is that they allow that debt-to-income ratio to be what it is, but you can get more for your buck when you do that. So when you're doing that, understand that that's how lenders, that's how people who are approving you for a loan look at the situation. All right, 30-year fixed rate loan, 3.5% to 3.625%. That's down a little bit, but pockets in the country last week and around, even in Southern California, you could find a 3.5% 30-year fixed. Now, as again I said, that's the 20% down purchase borrower who has a 750 FICO score or above and has a debt-to-income ratio below 43%. And that is a golden borrower. Oh, and by the way, that's a W-2 earner, somebody who gets a weekly paycheck that has been going on for 2 years or more. That is, somebody who's golden. You can get the best rate and get that particular rate if you go out there and shop around. And the FHA VA loans, 3.25% to 3.5%. The 15-year fixed, 3.125 to 3.375. Now, you notice that the upper end of this 15-year at 3.75 is not that far off that 30-year fixed. So if you can afford that 3.5%, or maybe the payments on that 3.5% aren't too onerous, you might want to look at that 15, because if you can get into a 3.125%, look at the difference in the payments. And one you have to pay for 30 years, the other one you pay for 15 years. I think the 15-year loan is a hidden jewel if you can make the adjustment, obviously, in the higher mortgage payments. I know a lot of people like to minimize their payment, the lowest payment possible. I talked to a client yesterday, a guy we did a loan for maybe 3 years ago. It was for $750,000. And he was getting bombarded. 3 years? No, it was 5 years ago, because it was 60 months. He said, I'm getting bombarded from, Chase and Bank of America and mortgage companies to lower my interest rate. Because obviously, 5 years ago, I think the interest rate, maybe he had a 3.75, and now they can get him, a quarter point less, which is the net tangible difference that you need to get in order to prove that, okay, then it's worth it, and they're not just trolling you to get churn on their loans. Those are industry terms, meaning that you have to get a benefit from your loan or they don't allow it. And churning a loan simply means that in the big bad old days, when the economy was falling apart and the mortgage meltdown was happening, people were doing a loan on their house 2 to 3 times a year because the equity kept rising, so they kept taking the money out. That's called churning. You don't want anything to do with churning. But the net tangible benefit for my friend would be okay. So he asked me, should we do it? Should I do it? Can I have you do it? So I said, okay, you have 5 years in this loan. Let's look at this straightforward. 5 years of interest on the loan. How much is that? So we did the math. And everybody knows on an amortized loan, the interest comes first. The principal comes second, meaning that the first 15 years of the loan, it's predominantly interest payments. The second 15 years of the loan are predominantly principal payments. So we did the math. He has already paid in $95,000 in interest on this loan. I said, okay, so what's the savings between what they're offering you and this $95,000, what's the difference? How long does it take you on a monthly basis, saving a couple $300 a month to get to $95,000? He said, oh, is that the deal? I said, yeah, that's the deal. I said, the secret, not the secret, but a strategy you can use with these people offering you, say, hey, look, I've already paid in $95,000 in interest. Can I get that applied to the interest that you guys are asking me for? Because then you might have a deal. Anyway, I'm Jeff Barton. I thank you for listening to the show. And each and every week we bring some great guests. We've got great guests again today. Some people in the energy sector. Certainly a terrific loan officer and also a lender is going to come on and talk about the programs they have. I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, the telephone number. Pick up the phone. Leave me a message. How about that? That's a new one for me. Leave me a message. Don't call because you can't get through right now. The switchboard operator told me that the whole thing has been shut down for some reason. No, I'm just joking. We try to get you to leave me some messages so that I can answer you later when I've got time and serious attention to what you're asking. A lot of things in real estate revolve around location, but some of the things evolve around the high cost of living, whether it's in electric or water or any of the other services that are, associated with living in a new home or even in your existing home. One of the guys that we brought on the show so many times to talk about energy, the energy situation both locally and nationally, is Zach Harmon. And he joins us again today from Las Vegas, Nevada. Zach, how are you?
Hey, Jeff, I'm doing well. Thanks for having me.
Thank you very much again for coming on. Okay, could you just tell our audience, those of you who haven't heard you before, what you do and how you might assist somebody in their search for possible different energy solutions for their home?
Yeah, of course. So I've been in the solar energy industry for 3 years now, a little over 3 years, and I own and operate a sales and marketing company. And what we do is we work with different local contractors in markets like Colorado, and really heavily in the Denver area, Las Vegas, Texas, and then we're going to be in Illinois here by the end of this week or next week at the latest. And so what we do is we offer solar solutions to residential homeowner and commercial businesses.
Okay, that's great. And I don't know if I told you, but we spent this summer installing some solar on our house. I have some issues with how it's currently done, but give me some statistics as to how many people are embracing solar, both in the places you're working and maybe nationally. So every market has a different cost of retail energy. So if you're in an average area like Las Vegas, the retail cost of energy is a price per kilowatt hour, right?
Which is very, in Las Vegas, similar to the national average, which is around 12 cents per kilowatt hour,
right?
And that's what it is currently. But as you know, just with everything, inflation, all prices for things go up, especially commodities like energy. Gas prices are going up, energy prices are going up. You probably know what the price of gas was 20 years ago, 10 years ago.
Yep.
It's going to be the same with electricity, especially because with the infrastructure that we're doing now, it's all fossil fuel energy, and that is finite energy.
Yep.
Whereas renewable energy, what solar does specifically is it locks in your rate, protects you from that. So instead of spending $100,000 over the next 20 years, which is right in line with the average homeowner is going to spend anywhere from $60,000 to $100,000 from a low and high end, you can get a solar system for a third of that cost, and then most people finance it on a monthly basis, just like you pay monthly for your energy, you'll pay monthly for the solar, and the solar will replace your electric utility payment, and it'll be locked in lower. And some states are offering short and long-term incentives for that, from incentivize money that's been put in a budget for the utility or the state to incentivize people to do it in the form of rebates, and then of course there's the 30% tax credit.
Yeah, and does that go away this year? Someone told me it goes away in 2020 or end of 2019. Is that true?
It goes down to 26%, I believe.
I see.
27, which is such a it's hardly a difference. In my eyes, it's still such a huge chunk. And
yep.
Yeah.
And it's direct tax relief. It's dollar for dollar, meaning that if you have a tax bill of $30,000 and you have a solar credit of $10,000, that means you pay $10,000 less in taxes. That's right too, isn't it?
Yeah. So if you spend $3,000 a year in your example, and you've got this $10,000 credit, then every year you'll be using that up until it's over with. You know, you have up to 5 years to claim it.
Zach, tell me of the percentage of people who are using solar energy versus traditional means with oil and electric.
So the adoption rate for solar is still pretty low. I mean, the market is, it's very, very large. And I know that that they just announced that law in California, so that it mandated all new construction needs to be solar.
Yep.
You probably know a little bit more about that than I do because California is more saturated than any state for solar. More homeowners in California have solar than any other state in the country. And so it's a harder sale there from a sales standpoint, from a business standpoint.
Well, there's a lot
more
of
competition out there, so I don't do too much out there.
Right.
But I don't know what, as far as when they're enacting that or enforcing that law where all new construction has to have solar. I think it's going to be either this year or next year when they're going to really start enforcing it, because I know that the law came out last year.
Yeah, I like the law personally. I think if my own opinion, I think that governments, state and local, should assist people, especially in a place like California where the sun shines all the time, and I mean, it's free energy. Why wouldn't we want to contribute to less climate change by adopting more solar in terms of credits or whatever the cities and states can do to assist people? I just think it's a great idea. I know that where you mentioned in some of the states, especially like a state like Nevada, the sun shines there like forever. I mean, I don't know why or what they're doing. They did have some trouble last year, I remember, by lowering the amount that they buy your solar power from, right? I mean, they sell it to you for one number, but they only buy it for a lot less number. Why is that?
Now that's the price of energy. I mean, that's pretty standard among utility companies. I mean, utility companies will get it for a certain price. Like if we're using that example of 12 cents per kilowatt hour, they're probably getting it for 6 cents or 7 cents, and then they're charging you that.
Right. Yeah, but if I now am making my own solar power and sell it back to them, how come I don't get the same rate that they're selling it to me at? If they're selling it to me for 12 cents, but they don't. They buy it to you from the rate that they're buying it from at 6 cents. It just doesn't seem fair. I'm making my own energy. I'm required to sell it back to them, and yet they're only paying me half of what they're selling it to me for.
Right. It depends on which market you're at. And
I see.
Which utility companies does that. And that's the great thing is that, utility companies are changing and markets are getting deregulated. So more utility companies and cooperatives are coming into the market, and they'll offer a better net metering rate. You can always switch it out to another utility company that has jurisdiction in your area, and so that's another exciting thing about the future of the market as we see that happen. And from somebody who lives in Las Vegas, hopefully we see Nevada energy get deregulated, and we have other companies come in and offer a better net metering rate for customers, for solar customers, because I imagine that would be a great start at getting a portion of the market for your company as business, as you go towards the solar customers first, who might not have a great competitive net metering rate. And
right.
You offer them something else, you could get their business pretty quick.
Oh, that's a great idea, and I like the idea of competition in any marketplace. Tell me a little something about the batteries, if you wanted to go off-grid, just quickly. We have about a minute left.
Yeah, so batteries, you've got lithium option, and then you've got lead acid. Lithium are going to last longer. In any situation, you're going to want batteries that last long, and that you want to have a system up where you're only going to be cycling them 50%.
Okay.
So that you can maintain the life of the battery, but they're very, very expensive for lithium right now. I mean, I'm still excited to see the price come down and the technology get better.
Okay. Hey, Zach, could you shout out your phone number for people that want to talk to you about solar, about possibly helping them in their solar needs?
Yeah, definitely. Let me give you my office number, and you can just ask for me if one of my representatives picks up. And I'll give my Las Vegas number here. So it's 702-473-0067. Again, that's 702-473-0067. That'll reach my main office.
Thank you. And what's the name of your company again?
Name of the company is Capital Energy.
Excellent. Zach Harmon from Capital Energy. Thank you very much once again for coming on the show and laying out what's happening in the solar world. Thanks a lot, Zach.
Hey, thanks, Jeff. Talk soon.
Yeah, we'll talk very soon. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. Write down some questions that you want to ask me about any of the guests on the show or about what I'm talking about in the segments that I do. And call me up. Ask me a question. Maybe you have some questions on the house you're going to buy and maybe the price, or maybe you're looking at the options for your loan, anything. How do you qualify? There's all kinds of questions that you're going to need answers to, and we certainly are here to help you do that. On the show today, we have brought a couple of great people, and this is another one. Richard Impietro from Mortgage Solutions is joining us now, and he's going to tell us a little bit about what's going on over there and some of the programs that are popular now. Rich, how you doing?
Good. How are you, Jeff?
I'm great. Thank you very much, and thanks for coming on the show. It is mid-August. It's hot. People are trying to figure out whether prices are going up and down, but mortgage interest rates are pretty awesome right now.
Yeah, absolutely. Obviously, with some of the action that's recently taken place, can't find a better time to buy or refinance.
Yeah, I know. I agree 100%. Give us an example of some of the good products or some of the popular products that you're doing over at Mortgage Solutions.
Well, as you may recall from last time I was on your show, we are a government lender primarily, so we deal in the FHA and VA sector. And I would say the important sort of news to keep in mind relative to what's going on in that world is there's been some big changes coming around the corner with a recent mortgagee letter that FHA's published, where they have been allowing 85% cash out with FICO scores down to 500. They now are going to reduce their LTVs down to 80%.
So that's a big deal.
We're seeing, obviously with interest rates coming down, maybe simultaneously we're also seeing some tightening, if you will, relative to what may be perceived as a higher risk transaction. So no more 85% FHA cash outs as of September 1st. So if anybody wants to get on board with those, you got to have a case number issued prior to September 1st.
Okay, that's interesting. Go ahead.
Yeah, similarly, I was just going to comment that VA is doing the same thing. They have traditionally gone to 100% for the veterans on a cash-out deal, and they are now going to create special pooling for these loans over 90, which basically means the lenders are going to be probably doing them because of that feature they're going to create. So now you're going to see 90% as the max cash out on a VA loan. Again, historically it was 100%. So both of the two largest agencies are both tightening, if you will, for cash-out transactions.
Now, give me an idea. Do you think that's because of the economy or because of their business model has left them a little short in terms of what they need for reserves?
Not necessarily economy-related, but more so because of their experience relative to those particular transactions. I mean, that's what we see all the time with various investors. They will change their guidelines relative to the performance of specific pools.
Well, I did notice last week when we were doing the show and some of the research I'd done, we had some uptick in, delinquencies on FHA loans. That probably has something to do with it, right?
Especially in these buckets. Yes.
Right.
I mean, that's where they'll change. Now, VA's been doing 100% cash outs for as long as I've been doing this, and FHA's at 85. So this is a major, guideline change for them. That's kind of historical, if you want to use that term. But it's a big deal because it's going to affect a lot of people.
Yeah, and the reason for that is, as we were saying, is just because the underperformance of the product in the marketplace, or is this some philosophical thing that they're thinking, okay, we're going to have to change the way we do business because there's issues with how we're currently doing it.
Yeah, it's all, performance driven.
Right.
There's really no philosophy per se involved in it. I mean, they're in it like anybody else to, earn a buck.
Right.
So it's all,
Good
margin
point.
related. If those loans don't perform at a certain level, they're going to make the necessary adjustments. There'll probably be maybe some non-QM people that may fill up that space. I doubt it because FHA and VA are known for their low FICO. I mean, that's
Right.
where you go when you have a sub 500 deal. And so those people that are in the 520, 530, all the way to 580,
Yep.
and have been getting 85% cash outs, no more.
Yeah, that's going to affect a lot of people. You are absolutely right. How's business, by the way? How is the pool of FHA loans? Do you see them increasing, decreasing? I always wonder when the economy's good, what happens to FHA? You don't hear a lot about it. What's your opinion?
Well, as you might expect, rising tide raises all boats. So
Right.
we're, doing quite well as a function of the market and interest rates. So we go right along with everybody else. The business is great right now. The impact of these changes, fully remains to be seen. Who might fill it in with, obviously, the patch that Fannie Mae has been implementing as well with their ratios. That could move more business to the government side, potentially. So I guess there's shifting seas going on right now. And
Right.
come after the, September 1st, we're going to see some changes in Fannie Freddie, changes in FHA VA, and of course the non-QM people are, scrambling as well, trying to, get their products to fill in where they can, where these private investors might want to take those risks. But when you get into that market, you're getting to some pretty high interest rates.
Well, yeah, I mean, in comparison to a 3.5% rate, if you were going to pay 5.5%, 6% or more, yeah, those are really high rates. But still, historically, not too bad, in the non-QM world.
Absolutely. I mean, I wouldn't be complaining if I had a place to still get a loan and
Right.
all I had was a couple bank statements or something to show for it. You can still get a loan for that. Is still nice to have available, even though you're going to pay more. But that's just the way it is. If you don't want to declare income on your tax returns, you pay more.
At Malibu, we do probably 15%, maybe 20% certain months FHA loans, FHA VA. Is that typical across the industry, or do you find shops and people catering to a specific borrower with low FICO scores going FHA route?
I would say the latter, Jeff. I mean, we
Okay.
have accounts that we deal with, fairly well-known accounts across the country that they focus on that type of market because the margins are higher.
Uh-huh, right.
So,
Of course they are.
And we do them on a non-delegated basis in many cases because then, that increases the margins even more. So you're right. Typical, larger mortgage brokers, maybe 15, 20% that they see come through almost by accident. But the other people that actually market to that segment,
Right.
Different story,
Right. We're speaking with Richard Impietro from Mortgage Solutions, predominantly FHA and VA. The mortgage insurance, are they adjusting that at all, or are they leaving that pretty much the way it is right now?
We're going to leave that alone. No changes to the mortgage insurance premiums. Those remain the same, so no impact there.
Okay. Interesting. Always changes in the marketplace. When you're dealing with, I guess, the customers that you have, which are in the basically wholesale world, right?
Right.
Okay. Dealing with them, do you get a sense from the marketplace as to nervousness about what's happening, or do you think it's just full guns blaring like it is until it isn't?
I think you're right. I think it's full steam ahead until it isn't.
Right.
I don't see any brokers or lenders applying a yield sign to their business. Given that most pipelines are full.
Yep.
And production facilities are, manufacturing centers, if you will, are moving along pretty good clip. I think people wait to see the drop before they react to it.
Right.
It's historically what I see happening. And then at that point in time, people just, the mortgage business has always been, my analogy, like an accordion, they lay off and hire as fast as you can say lickety split, it's just the way it goes. So they'll wait till the music stops,
Right.
And that's when they'll take action.
No, I agree with you 100%, but I also think that there are so many people out there wishing that the economy does poorly and wishing that a lot of the industries that really rely upon a good economy like ours does poorly. I don't know whether that's some sort of political slant or not, but I think the economy is doing well, and I would say ride the horse till you fall off,
Yeah. Well, it's somewhat of an oxymoron, as you well know, because in our business, a bad economy is in our favor.
Yes, it is.
Traditionally, that's what impacts rates the most. But we're in a unique environment.
Very unique.
The economy is very healthy.
And they cut short-term rates.
We have debt coming out of every possible orifice in the economy. That's the big problem.
Yeah, I know. And we talked about it earlier on the show. Richard, I'm out of time. Thanks for coming on the show. I really enjoyed your expertise and also the comments. You want to shout out your phone number to somebody who is interested in talking to you about one of these great products?
You betcha. 949-287-9525.
Okay. Thanks very much, Richard. I really appreciate you coming on the show again.
My pleasure. Take care.
Okay, and you too. Richard M. Pietro from Mortgage Solutions. I'm Jeff Barton, your voice in the mortgage industry. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, telephone number. Write it down. Ask the questions in your head. Make sure that you are aware that you can call me anytime, not just during the show, but certainly tomorrow, next week. But mortgage questions, real estate questions, these things pop up in your head late at night, and you go, oh my gosh, I wish I could have asked somebody. If you write them down, pick up the phone. Hey, you know what? You can email me too. info@malibufunding.net. My Twitter handle is @Jeff6493. I'm on YouTube. I don't know. What else is there? There's nothing else. That's it. I've covered it all. We're on Instagram, too. We're on Facebook. We're on, our website is malibufunding.net. Anyway, I bring to the show the best, always, and today is no exception. Brenda Scott joining us once again from Malibu Funding. Terrific loan officer, good person. Brenda, how are you?
I'm terrific. How you doing, Jeff?
I'm good too. Thank you very much. In the last couple times I had you on the show, we had you fired up about customers who were making you cranky. How's it going right now?
Still the same way.
Yeah. No, I understand. But you find solutions where others can't. That's what I like about you. You've got a no-give-up attitude, and, somebody that won't take no for an answer for a client is always a good advocate, especially in the loan business.
Yes, it is. In this industry, there's nothing black and white. You just got to make it work, and you got to make it work for your client. And I don't have a problem doing that at all. I'm working up some reverse mortgages. Those are very, very good loans, but they're very tough because clients have to understand is they don't qualify for that mortgage. It's the house that's qualifying for that mortgage.
Good point.
But
good point.
They don't qualify. It's the house, so you got to make sure your house is secure, no holes, no leaks. It has to be pretty much in perfect condition.
Right, and don't you have to have a great amount of equity in that particular home in order to even think about a reverse?
A good bit of equity. You don't have to have a whole bunch of equity, but where I have run into clients that they qualify for the reverse mortgage, no problem, hand down, but they may not qualify to get the cash out.
I see.
Some of them want $50,000, $60,000, $100,000 cash out, but they're not qualified. The house won't qualify to give them the cash out, but they qualify for the reverse mortgage.
I see. So basically they could go to the no payment route but can't take cash out, which,
Exactly. And another issue, Jeff, is if they can't prove that they can make the taxes and the insurance payments on the reverse mortgage, the lender will do what they call a lisa, which means they will do a certain amount of money to hold back to pay their taxes and their insurance. So they still can get the reverse mortgage and still have absolutely no mortgage, no taxes, no insurance. Everything is paid for.
That's a great program, but that is a fairly new requirement, right, in the last couple of years?
Absolutely. They've changed it. And now, as I said, they don't look at your credit. I have one right now. The FICO score is like 520. And we got the ball rolling on it. We got past the first stage, and the requirement is the house. Your house has to qualify.
Now, when you get the counseling done, what is the counseling? I know that it's required, and I know that a lot of loan officers get nervous when a third party comes in and starts to talk to the client about their reverse product. Tell us a little bit about the counseling and your experiences with it.
Well, the counseling is really protecting the borrower.
Right.
The counseling will go through and they will first ask the client if they have any questions, any concerns, anything that your loan officer may have gone over with you and you don't understand it. But keep in mind, when we do these counseling, I'm right there with the borrower.
Well, that's good too. Yeah.
I don't let them do that counseling by themselves, and I'm there with a piece of paper and a pencil going, yes, no, don't answer that, da. But the counseling is really to make sure that they know what they're getting into. That's really what it is. Right.
No, I think historically there were issues with, houses, I guess, getting taken by, unscrupulous lenders during the reverse mortgage process, especially when the spouse passed away, or one of the spouses who had the mortgage passed away, that the house would get lost. That doesn't happen anymore. There's nothing like that. This is part of the process that basically was used to fix that problem, right?
Absolutely. I had a client that a while back they got a reverse mortgage. He had the requirement, the age requirement, but the wife did not. She was fairly young.
I see.
And she is still in that property today, still not making any mortgage payment.
Yeah, that's a good point, too. It has to be one of the people, I guess if they're married, one of the person has to be over 62, but the other does not, right? And then they get the full benefits of the program if the older one passes away.
Absolutely. Full benefits.
That's
full benefits.
Excellent. Okay, so where do you see the market going? I mean, you're out there in the world. People are buying and selling houses. Do you think the real estate market is going to sustain its price increase the way it has been over the last couple of months? Do you think we're looking into a fall slowdown? What's happening? Yeah,
I'm working with a couple of agents, and man, this market is high. I mean, he's putting 3, 4, 5 offers, and they have multiple offers, and I'm not talking on not just high-end properties. These property values are very, very high right now. But the good thing is the interest rates are doing phenomenally well right now. So this is still a good time to buy.
I agree. If the interest rates were to rise, which I don't think they're going to, they're talking about the short-term interest rates getting lowered another, 25 or 50 basis points, which only means it's going to drag the mortgage rates with it, especially if we continue to get the yields that we're not getting on the T-bills because we have so much foreign money coming into the country. It's a very interesting time.
Right. And they have so many programs out here now.
Yeah.
They got bank statements.
Right.
They got excellent programs for a non-owner,
right.
for your non-traditional borrowers, and those rates are still phenomenally good.
The rates are really good. I was just talking to our last guest and telling him, I said, look, you get into a non-QM product, and everybody in the listening audience knows non-QM means basically that you're not getting a 30-year fixed rate loan with 20% down, the perfect borrower. You're outside, you're a bank statement, or you're a self-employed borrower, or, any of these outside the box. the rates are still, 5%, 5.5%.
Exactly.
What's wrong with that?
They're very good. Very
Right.
good. And non-owners, I mean, all you got to do is have a Social Security number to get a non-owner occupied loan.
Right.
So they're real fun. They're good too. Very good.
Hey,
Good market. It's a good market. It's a tough market.
Yeah.
Lenders are busy, so everybody. I tell clients, just be patient. Just be patient, and you'll get what was promised to you.
Hey, could you shout out your phone number and then tell us a little bit about the areas you serve in and around San Bernardino, Riverside, Los Angeles, Ventura counties?
Absolutely. It's 562-500-2400. Call me. Ask me any questions. It's a free. I won't even charge you for the phone call.
Exactly. That's that's how it works. Very nice. Brenda, I appreciate
Free
you.
phone calls.
What? Free phone calls.
Free phone calls at Malibu Funding.
Well, if anyone out there is listening wants somebody to really work for them, and obviously talking a lot today about reverses, it's a great program for over 62, and I highly recommend it, or at least listening to the explanation so that you can take full advantage of it, especially if you're on a fixed income and you just can't see your way paying the mortgage rates when your income obviously is fixed now that you're over 62 or 65 years old.
Right. And insurance is going up, taxes is going up. This is a perfect program.
Brenda, thank you very much for coming on the show once again.
All right. Thank you, Jeff. Have a great day.
And you too. That's Brenda
See y'all
Scott.
later.
Okay. Brenda Scott from Malibu Funding. And I'm Jeff Barton, your voice in the mortgage industry. And we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. The telephone number, the email address is info@malibufunding.net. I have a Twitter handle, and I tweet out occasionally, about once a week, a thing called the Mortgage Minute. This is 1 minute of me talking to you about what's going on in the mortgage industry. Anyway, my Mortgage Minute Twitter handle is @Jeff6493. Now you may say, well, how am I going to remember that? Well, once you say, how am I going to remember that, you're going to remember Jeff or @Jeff6493. And that's where you're going to find the daily. And recently I was talking on the Mortgage Minute about the economy. I think the economy is at the core of what everything is going to happen in the next year. Now, why do I say that? Because I don't believe it's the foreign trade issue with China, although that has a lot to do with what you're paying at not the grocery store, but at Walmart and some of the other things. I saw an article that said that each household in America is going to pay an additional $1,000 this year based on the Trump tariffs. So that's something to chew on. And again, I did not do the math myself, and I don't know how the economists or the bean counters do that kind of stuff. But I believe the article. That makes kind of sense. I mean, if you're placing that many tariffs on that many goods, obviously it's got to get passed on to somebody. So $1,000 extra a year. Oh, and by the way, what's $1,000 towards your mortgage payment? If you could, add another $75 a month in your mortgage payment, it's probably another $50,000 that you cannot afford because of the Trump tariffs. I guess that's why it is important. We talked about it some last week. But let's talk about the economy, what's happening in the economy. I want to bring Daryl in now and ask him about his opinion, and maybe it's just anecdotal, but the rate cut by the Fed, and they're thinking of doing it 2 or 3 more times. Do you think that's a good thing? You think that's a bad thing?
I think that it didn't stabilize well enough to start raising the rates, and leaving them where they are shows no progress in either direction. I mean, stagnant rates mean people go, well, what's the matter? Right? If it's not going up or down, people get wonky and weird and nervous.
That's exactly right. That's right.
So you have to do something. You have to either raise them or lower them, and lowering them, again, gives the indication that you're trying to grease the rails of commerce.
This is exactly what this article I was reading. I don't know if you know what the Schiller real estate survey is every month or every quarter. They come out and they talk about what's going on in the real estate market all across the country. But the guy named Robert Schiller, who is an economist, CNBC guy, he came on and he spoke to just the opposite, but it's in the same argument, meaning, okay, if you raise rates, you are sending a signal to the market that the economy is doing well and you got to cool it off because that's an inflation hedge, right? I mean, that's what the Fed does. Their primary mission is to watch for inflation, although inflation currently is not at their target range, which is, I guess, 2% a year. And again, I am not an economist, but at 2% a year, you're factoring in wages, really, which is the good thing, and products that have to rise in order to afford the wages, and they're thinking 2% rate is a good thing. This guy Schiller, Robert Schiller, he is a Nobel Prize winning guy in economics. He says the opposite. He said, look, if you lower rates, you're sending a signal to the market that there's a problem with the economy. And it has really borne out in the last 2 or 3 weeks since the Fed has reduced short-term interest rates. And what do I mean by that? Well, you can see that in this thing, when countries are selling bonds. You know what bonds are, right? It's debt. They're really saying, okay, I'm going to let you buy something from me right now that I will pay you back plus 2% in 10 years, meaning you're going to be making 2% a year for 10 years. And, so you got to give me the money now. That's how the federal government runs. That's how it pays its bills. You may have heard of something called the debt ceiling, and they raise it periodically. And during the past, 3 years, we've had government shutdowns because they refuse to raise the debt ceiling. This is grandstanding on many people's part. It's part and parcel to, you going to the grocery store and they're rejecting your credit card and you taking everybody in the store hostage because you can't get more credit on your credit card to buy food. Well, that's exactly what it was with the federal government. They're currently on a 2-year extension of the debt ceiling to some astronomical number. The debts. Do you know what the debt is right now? National debt.
Trillions and trillions of dollars.
$22 trillion. $22 trillion. And do you know how much every dollar you spend in taxes to the federal government goes towards that debt?
Probably nothing.
25%, and it's rising.
Oh, in that way, okay.
So if I pay federal taxes,
but no, I thought you were asking whether we were paying it down. We're not. Paying
oh heck no, no. When current administration got in, every administration does this. Please don't inundate me with I'm a Trump hater. I'm not a Trump hater or a Trump lover. I'm just telling you the way it is. Obama did it, Bush did it, Clinton did it. They all said, well, actually, Clinton did do it. He was one of the few guys in the last 30 years to actually bring the deficit down somewhat. But anyway, we have added, since Obama, probably $14 trillion to the debt, maybe a little bit more. Trump is prepared for this new budget to add another $4 trillion to the debt. When he came into office, he promised that he would eliminate it in 8 years. And of course, we all know that was ludicrous and silly because there's no chance unless you're basically saying, I'm going to shut down all the government, take all the money we get and pay off all the debts. That's the only way that you can pay down this debt to nothing. So does it matter? Yeah, it matters.
Yeah, but that's a going out of business sale.
That's a going out of business sale. That's exactly right. And I don't think America's going out of business, which brings us back.
I hope not.
Yeah, well, it brings us back to the rates and what we were talking about in terms of the deficit and what we're talking about in terms of the overall economy. And there's this thing, and we've talked about it on the show, called the inverted curve. What does that mean? So the U.S. sells debt all the time. They sell it in the form of treasuries. The treasuries themselves are sold in increments of 30, 10, 2, and 3-month notes, I believe. There may be more increments, but those are the ones I'm kind of familiar with. So when they sell, they get money now and pay more later. So what happens when you have a longer debt? You usually pay more, right? A short-term debt, you pay less. Well, when those things get reversed, i.e. the 2-year treasury note was yielding more than the 10-year treasury note, that's a problem. And that has been a portend, a foreteller, a prognosticator of past recessions. 7 out of the last 10 have been preceded by this particular phenomenon. So I did a little digging, what they call deep dive now. When you do some additional research, really reading one more article, that's my deep dive. It basically said the reason those particular things have occurred is because the yield on the long-term bond went down simply because around the world there are many major economies not doing well. What is a recession? 2 straight quarters of negative growth. We have Germany in one of those currently. We have several Italy. We have several other European nations teetering on the brink of a recession, which simply means the debt in those countries is not as safe as it is in the U.S. So a lot of foreign money came into the U.S. And what it said was in the article, tons of money came in, and thus driving the price or the yield, how much you could get for buying a treasury, down. And that's what caused the inverted particular curve on the 2 and the 10-year. Now, again, not being an economist, and what does this have to do with me and my mortgage? It says that the job you currently have is probably safe for now. That this dreaded recession that they're talking about, 30% chance, that's what they call in the article. Not 80, not 70. And people that you watch on TV that are crying Chicken Little, well, take it with a grain of salt. Do a little bit of research on your own. You're going to be much more satisfied with what you read rather than what they tell you. And again, I know I'm telling you too, but just do that and you'll be much better off. Anyway, I'm Jeff Barton. This has been a great show. Really appreciate you listening. And I am the Mortgage Voice. How about that? I am the Mortgage Voice. And we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.